Hi there, welcome to Q&A with Kneppy Invests. So in this video, what I do is answer questions that were left in the comment section of my initial and first Q&A video. Now, if you don't want me to answer some of the questions you might have, make sure you leave it in the comment section of this video. So let's get stuck into it and answer the first question. So the first question is in regards to what training books I would recommend for a beginner to start. So two little things I want to touch upon here is when they talk about training book, I'm going to assume they're a beginner investor. So if they are a beginner investor, I would recommend investing books over training books. And maybe if you become more knowledgeable in regards to investing, then you can sort of graduate to training books. There is a bit of a difference. The other thing is beginner. So there's different sorts of beginners when it comes to investing. When I first started to invest, even though I was a beginner, I had a lot of knowledge that I could climb aboard and use that knowledge when I started investing. So if you're brand new to financing, to looking at the markets, to trying to know what sort of company you want to buy into, I think you have to start right at the bottom and work your way up. And I'm not even sure how you start at that point. Maybe go to the ASX website. They have a lot of information on that for beginner investors. So that's probably where I would start first, is the ASX website, and start there and maybe work your way up. If you want to leave another question in regards to that, feel free to do it. But now I'm just going to recommend two books that I do think would be very helpful for any investor out there. The first book I'm going to recommend was written by a legend in the investing circles. And that's One Up on Wall Street by Peter Lynch. And there's no one who could argue with me that this guy isn't a legend when it comes to investing. This is one of the greatest investors of all time. In fact, I would argue he might be the best investor who has ever lived. So a bit of background with Peter Lynch. So in 1977, he created Magellan Fund within Fidelity Investments. Funds under management when he started Magellan was 18 million, and over the next 13 years, he grew that 18 million to $14 billion. In fact, his annualized returns were 29.2% per year, significantly more than double the market returns, and that's exactly what you should be looking at as a private investor. And to do that with a fund is something else. So it was the best performing fund through that 13-year period. And then he retired in 1990 at age 46. He wrote One Up on Wall Street in 1989, and he's written a few other books. So this guy is considered a legend in investing circles. So when I first read this book, it was just soon after I started investing. So I didn't know about Peter Lynch, and I decided why not learn from a legend. So these are some of the things I took away from reading this book. Anyone is able to get better results than professional Wall Street investors. I've heard a lot in the past that you, as a private investor, cannot beat the market, so why should you try? Just put your money in ETFs. That's complete and utter hogwash BS. You can beat the market returns. And actually, I'm showing you that in my portfolio that I'm doing right now, because you have so many more advantages over fund managers, significant more advantages, and you should be able to use those advantages to your advantage. So anyone is able to do that, and he actually said that in his book. Buy debt-free companies. So this is something I do all the time. I try to stay away from any company that has a significant amount of debt. A little bit of debt is okay, but I like companies with no debt. In fact, the other day I looked at a company called iCollege, and even though this debt wasn't much, only $18,000 debt, the interest rates on that debt were 15%. So even though we're in a low interest rate environment, there's still a lot of debt out there that small companies have that are fairly high. So buy debt-free companies. The only reason companies go bankrupt is because of debt. Look for 10 baggers. I think he might have been the one who came up with the term 10 baggers or baggers. So it has to do with baseball. But I'm always on the lookout for companies who have the potential to increase in price by 1,000%. So I'm always on the lookout for those sort of companies. And he also came up with this scuttlebutt, invest in stuff you know. Now, I'm not a big proponent of that at this point in time, but when I first started investing, I always had to look out for things I knew. So I'd go into shops, see how they do. And for instance, in 2017, I started seeing Afterpay signs pop up in window shops fronts, and I started hearing people talk about Afterpay, and that was the time to buy it because everyone started talking about it. I started seeing Afterpay signs more and more. I always went into JB Hi-Fi to see how business were doing. Then I go into Dick Smith Electronics, and it was the complete opposite. It was completely dead. I thought at that point in time, JB Hi-Fi would be the company to buy, not Dick Smith. Just that sort of thing. Just invest in what you know. From one legend of investing to another, and of course I'm talking about Warren Buffett. So this is probably the most successful investor of all time. He's definitely the most renowned investor of all time. So most people do know the name Warren Buffett. So he runs a company called Berkshire Hathaway with another great investor called Charlie Munger. They're both in their 90s, so quite old, but they've been running this company for over 50 years. And during that 50 years, between 1965 and 2020, the returns of Berkshire Hathaway have been 20% per year, double the market returns. So that's again showing you that you're able to double the market returns in your investing life. In fact, Warren Buffett has said that if he was a private investor and not managing so much money, his returns on an annualized basis will be significantly higher than 20%. But he's constrained by the fact that he's managing so much money. So he's saying right there that fund managers have a disadvantage over you, the private investor. So we should be able to take advantage of our advantages as a private investor and supercharge our returns and beat the market consistently. Anyway, every year Warren Buffett writes letters to shareholders, and you can read any of these letters to shareholders online for free, but you can also buy some books which compile these letters together, and this is one of them, Berkshire Hathaway, Letters to Shareholders, 1965 to 2020. Now, within these letters, there's so many nuggets you can learn from. So I would recommend reading these letters. It might take you a while, but you can learn so much. And I'll just give you some examples of what I've learned by reading these letters. Price is what you pay. Value is what you get. This is sort of the central mantra for value investors. It's all about buying at the lowest price possible for any company you do like. Because if you can buy at the lowest price possible, you're getting it for the best value. And that is actually true for a lot of things in life. So price is what you pay, value is what you get. So always try to buy a company you like for the lowest possible price. Be fearful when others are greedy, and greedy only when others are fearful. Perfect example of this is when you go through crashes in the stock market. So for instance, during the COVID-19 financial panic, when the stock market got down to 4,400, there were so many people so fearful about the future prices, the future state of the stock market. But that would have been the most perfect time to buy. Now it's at 7,000, and those same people who were very fearful back then are now becoming greedy, saying, oh, this is a great time to buy. And another perfect example of this was in 2012. I went to this online forum, and there was a post. This was not an investing forum. It's just a general forum. I forget exactly what it was. And someone mentioned they were thinking about investing into the stock market. And as soon as they mentioned or posted this comment or this question, there was a lot of feedback saying, oh, the stock market is horrible. Why would you invest in the stock market? Blah, blah, blah. But in 2012 was the most perfect time to invest in the stock market because everyone was so fearful back then, and you're getting really good prices for so many really good companies. So that's when you start buying, when everyone is so fearful. And right now it's the complete opposite. Everyone is so optimistic about the stock market. I've heard some professionals say we should be expecting a 20% rise in the stocks during the rest of this year. Stock markets are only going up. And this is when you should become more cautious, more pessimistic, because everyone is getting so excited. In fact, I believe Berkshire Hathaway is increasing their cash on hand. And when Berkshire Hathaway starts increasing their cash on hand, really increasing that, that's when you should become more cautious. Look for companies that reinvest their earnings into growth. My favorite saying from Warren Buffett. And in my opinion, if every Australian investor and every Australian company had this mantra on their wall at work or at home, we'd be a much better country as a whole. Because in my opinion, dividends, or our obsession with dividends, is harmful to the country because dividends suppress innovation and growth. And this is exactly what Warren Buffett is saying here. And this is actually something that Jeff Bezos of Amazon believes in as well. I like companies that reinvest their earnings into growth instead of giving those earnings back to the shareholders as dividends. Because when a company makes money, makes earnings or profit, they have some decisions they have to make. And how they use those earnings is very important. They can give the money back as dividends to shareholders, share buybacks, or they can reinvest that money into future growth. And if they reinvest that money into future growth, the company is going to grow, the country is going to grow. But our obsession with dividends is suppressing that growth because we are so obsessed with our dividend checks, so obsessed. We are the most dividend obsessed country in the world, and it is harmful. End of story, end of rant. Raising debt is like playing Russian roulette. So just like Peter Lynch, Warren Buffett doesn't like companies with too much debt. Neither do I, neither should you. Debt is bad. And just like if you're playing Russian roulette, hopefully you have never played Russian roulette because the outcome is bad for someone. And the same for companies with too much debt. Eventually the outcome is going to be bad. The second question can be broken down into 3 parts. So I'll separate or answer each part of this question separately. And the first part of the question is all about portfolio size. And I wonder if it would be a good idea to limit the number of stocks in a portfolio. Now, there's no right answer to this in my opinion because I know some investors have only 2 or 3 companies in their portfolio. I know other investors have well over 50 companies in their portfolio. So it's all about knowing what sort of investor you are, what sort of personality you are. So those sort of investors with only 2 or 3 companies in their portfolio are more of the high conviction sort of people who come up with an idea and have high conviction behind that idea. In fact, there are some investors out there who have one idea and they put all their money into that idea, and you can become really rich if that idea works really well or pays off. Other people have not quite as high conviction. So they have many sort of different ideas and they buy 50, 75 companies. And the investing philosophy behind that is a few of those companies will become highly successful, become 10, 20, 50 baggers, and that's how you make your money. And what they are hoping for is a success rate of say 50 to 60% of their ideas will become successful and the other companies won't. But all you need is a 60% success rate to make a lot of money. And I know that works for them and the other way works for those people. So it all depends on what sort of investor you are. So it's very important that you understand what sort of investor you are. The second part of the question is all about stop losses, also the use of stop losses for long-term investments. Now, I actually don't use stop losses now. I did about 8 or 9 months or years ago, but on 2 occasions, I was stopped out of a company I owned, and more than likely, I was stopped out of those companies because I wasn't quite sure where to set stop losses. So traders knew that, not me personally, but they knew some people might set their stop losses too high, so they forced the share price down to trigger stop losses. And then as soon as those stop losses were triggered, the share price would go on a run. And that's exactly what happened. I was stopped out of a couple of companies and the share price just went higher and higher from then on. So I stopped using stop losses. And the way I look at it now, I don't need to use stop losses because I have an idea at what price I need to sell out of a company. For example, Treasury Wine, if the share price got below $10.20, I would sell. So I don't need to use a stop loss to know that. And I follow the Treasury Wine stock price or share price every single day. So I know when it gets below that level, so I don't need to use a stop loss. Now, if you weren't following the share price movement of companies you own on a daily basis, maybe stop losses would be beneficial, but for me, they have no benefit. And the final part of the question was in regards to something Motley Fool said, 57% of trades came from sellers. And the person who wrote this question said, how do they determine this? I thought each trade has a buyer and a seller. So what Motley Fool is saying here is in regards to who initiates the trade. So there's always an initiator of a trade. every single trade. There is an initiator. For example, if I put a buy bid in for a company at $1.98, I am not the initiator of the trade. There has to be a seller who initiates the trade. So if you put a bid in to the market, you're never going to be the initiator of the trade. If you buy at market, you're the initiator, or sell at market, you're actually the initiator of the trade. And that's what Motley Fool is talking about here. 57% of trades are initiated from sellers. On to the third question, all about AVZ Minerals. And fun enough, I am a holder of this company. So it's always good to read a question about a company you do own. Now, this was a company I was trading a lot about 2 years ago or so, because they had a lot of volatility in the share price, going from like 5 cents to 9 cents, back to 5 cents, back to 9 cents. And traders love volatility. That's how they make the money. But as I did more research in this company, and as the lithium boom started, I thought I'd just keep a holding and just maintain that holding without trading it. So what do AVZ Minerals do? Well, they are a lithium developer in Democratic Republic of Congo. Now, saying they're a lithium developer, they're a little more diversified than that. They're also into tin, but for all intents and purposes, we'll just talk about their lithium development in the Democratic Republic of Congo. Now, the main reason I was trading AVZ was just the share price movements, but I did read this one presentation from another company, not AVZ, and they had a very similar diagram than this, and they're trying to sell their company because this company had one of those big circles to the far left of AVZ. But when I looked at this diagram, I saw AVZ was to the far right, and even though this company was trying to sell their deposit, when I looked at that diagram, all I saw was AVZ had a massive deposit. So I did a little bit more research on AVZ. So there are advantages to AVZ and there's some disadvantages. So a bear case and a bull case, and I'll get into that in the next slide. So with every company, there is a bull case and a bear case with the story. So what are the bull cases for AVZ Mineral? Now, it's all about lithium. So lithium is going through a bit of a bull run right now. A lot of tailwinds behind it. But a few years ago, maybe 3 or 4 years ago, we did see lithium companies and the lithium price go through a bit of a bull run and then really backed off a lot. So I think a lot of people were spooked out by that, but I think that was too early. And sometimes trends can be too early. If you talk about the 1999-2000 tech bubble, a lot of those stories were too early. If they just waited 10 years, they would have been highly successful. For instance, Leonardo da Vinci drew some helicopter photos, or not photos, pictures, but he was just 500 years too early. If he just waited 500 years, he could have been the developer of helicopters. So sometimes it's all about timing when it comes to stories like lithium. And right now, it could be the start of this massive bull run in lithium, because lithium is going to be needed in a substantially greater way in the future when it comes to batteries. Size of the deposit. So the previous slide just showed you that the size of the AVZ deposit is massive, and the mine life is going to be greater than 20 years. It could be significantly greater than 20 years. So that's one big bull case around AVZ Minerals. And the other one is their offtake agreements. Now, I'm not the biggest fan of offtake agreements, because it all comes to whether they can get the mine into production or not. That's when the offtake agreements come into effect. So I think there's a lot of people like these offtake agreements. I'm not a big fan of them at all, in fact. Now, with every bull case, there is going to be some bear cases. So what's the bear case around AVZ Minerals? And the first one is sovereign risk. So they want to develop this mine in the Democratic Republic of Congo, a very poor country in Africa. And we've seen recently a lot of Australian mining companies are becoming, there's a lot of issues with a lot of African countries. I think those African countries are getting pressure from China. Now, this is just my assumptions here. They're getting pressure from China to try to harm Australian interests in those countries, because China has been giving a lot of these African countries a lot of money to develop infrastructure. But in saying that, I did read a tweet the other day that mentioned that Democratic Republic of Congo could be the Persian Gulf story of the 21st century. So those Persian Gulf countries, Saudi Arabia, really benefited from the oil explosion in the 19th or the 20th century. And maybe the Democratic Republic of Congo will benefit from this explosion in lithium in the future. and the amount of capital expenditure they need to get to production over 500 million. So they're going to have to get into debt or raise a lot of capital, and they're raising a lot of, or they have been raising a lot of capital the last few years. So that's one concern to me, is what they're going to do with the capital expenditure to get to production. $500 million is a lot of money to get to production. On to the next question, all about AVA. So I have been a long-term shareholder of this company. So what's my thoughts about the current bearish share price and subholder selling or profit-taking market cycle leading to oversold? So when he's talking about the bearish share price, this is the chart for AVA group for, I think this is a 6-month chart, and the share price reached a peak in late November at just above $70, so very close to $80. And I've just drawn in the downtrend. So the share price in AVA Group is in a downtrend right now. So that's why he's saying the bearish share price, because the share price is in a downtrend, and a downtrend is bearish. So even though the AVA Group share price is in a bearish downtrend, when I look at the financial numbers of this company, my concerns are washed away, largely anyway. So the market cap of the AVA Group is only $116 million. When you look at the revenue and most definitely the operational cash flow, you can see there is some value right there. So revenue is $61 million, and they are operational cash flow positive to the tune of $13.4 million. So that's fairly high for a growing company with a market cap of 116 million. So they are actually very good value at these current share prices. In fact, when I calculated the enterprise value to operational cash flow, I get a number of 7.7. That is exceedingly low for a growth company. In fact, what I do is any number less than 6 is actually good value for a non-growth company, and this is a growth company with an enterprise value to operational cash flow of 7.7. So my concerns are largely washed away. So why am I saying largely? Well, there is a reason or a cause of concern when I read the half-yearly report. So this was a little bit of a snippet in the half-yearly report that was of concern to me. Now, the market is forward-looking, so all these financial numbers I showed you was all about AVA Group's past. And this little snippet in the half-yearly was maybe suggesting to the market that the future for AVA Group was not going to be quite as bright as what we've been seeing in the past. So their growth rate might not be there. So this little snippet said 31st of December 2020 sales order backlog of 3.4 million, in brackets, half year 2020, 16.7 million. So that did raise my eyebrows. Why is that sales order backlog so much lower than it was not that long ago? In fact, it's down 13.3 million. So that actually did raise my eyebrows, and that was the one concern for me. And I think no doubt that is concern to the market as well, and that's why the share price is falling. And on to the final question of the day, and again, this question can be divided into 3 different parts. So I'll address these different parts in different slides. So the first part of the question is, how would you describe your investment style? So when I first started investing, it was all about value, finding value companies, value plays, and researching companies, having a thesis behind my buys, and then just buying, holding, and hoping that the company or the market would see the same thesis that I drew up, and the share price would go up and up and up. Now that sort of investing style was not suited to me. So I think you really have to understand your personality and what sort of investment style would suit your personality. So my investment style has evolved and adapted through time. And now I'm being more driven by momentum, sentiment sort of strategies. And even that strategy is evolving as we speak. In fact, today I've made a subtle shift to the way I look at charts. So in the past, I've been looking at 20, 50, and 100-day moving averages. Now I've changed to looking at 10, 20, and 50-day moving averages. And the whole reason I've done that is I'm looking at trying swing trading, because I believe swing trading could suit my personality and maybe a good investment style to try, because I do know it can be very successful. So I believe that you should always think of adapting your investment style, just stick to the one style of trading or investing. Some people believe there is only one way to invest, but I believe those people are stuck in sort of a very rigid mindset, and they can never improve their way to invest. And I'm always thinking, How can I improve the way I invest? How can I make more money, get better returns in the future? The second part of the question is all about whether I'm interested in future trends. Yes, I am. And I can say that emphatically. In fact, the main reason I don't want to die is because I just want to see what the world is like in 100, 200, 500, even 1,000 years. In fact, if I could get into a time machine right now and go 1,000 years into the future, I wish I could. So I'm just so interested in what sort of trends become successful, what sort of trends don't. So what are some of the trends that I'm really interested in right now? The first one is space and communications, particularly communications. So I have no doubt all of our internets will come via satellites. In fact, I have no doubt about this. It's happening right now. We're putting more satellites in space so we all can get internet via satellites. And the advantages around that are huge. Just imagine you go into the desert, your car gets stuck in the middle of the desert, you have internet via space, you can just get in contact with O or someone and they can come and rescue you. You don't need a satellite phone. People get stuck in the deserts every single year. We have remote areas that don't have internet right now, or maybe internet by satellite, costs a fortune, and eventually become cheaper, and everyone will have access to the internet. The other thing about the increase or the massive increase in satellites in space is the amount of space debris. You might not understand or realize the amount of space debris right now that we have to contend with. Space debris mitigation is a thing. And the other day, EOS, one of the most interesting companies on the ASX, perhaps the most interesting company, released an announcement to the market in regards to a laser space debris mitigation thing they have developed recently. So this is all about mitigating the amount of space debris that can be harmful to satellite sort of infrastructure. So have a look at that announcement. It's a very exciting space, and I have no doubt this is going to grow in the future. And have a look at EOS, one of the most exciting, if not the most exciting company on the ASX. And I'm a little bit biased there because I am a shareholder. Anti-aging. So, look, I could be a little bit biased here because I hope to live for way longer than a life expectancy that I have right now, which is probably about 90. So I still have quite a few more decades to live, but I want to live longer than that. Now, I was reading something the other day that it said most people would be surprised where we are in regards to anti-aging. We are much further in the process into anti-aging, and in this article they mention that most people right now that are around my age should be expected to live well above 100, in fact. So I think this could be a massive growth area for the next few decades. Transportation. So some controversial things I'm going to say here. A car purchase is the most inefficient use of your money without a doubt. You buy a car, say $50,000, and you rarely use that car unless you use it for work. Way more inefficient use of money you could put that to. You could put that money into investing and actually make a return on that $50,000. And in fact, you're losing money by owning a car. I have no doubt, I'll put a time frame here, in 40 to 50 years, teenagers won't learn how to drive. I have no doubt in 40 to 50 years, the majority of people won't own cars because we'll have self-driving cars there for us. And if you need to go somewhere, you just order a car to pick you up. The self-driving car will come, pick you up, take you to your destination, drop you off, and that's it. A way more efficient use of car technology without a doubt. So I believe that's going to happen. Some people will resist that without a doubt, but it's an essential necessity we'll have to go through eventually. And I think in 100 years' time, I think they'll look back on us and go, why did people own cars? Why would they do that? That's just ridiculous. Food. Now, this is going to be a little bit controversial, but I believe, without doubt, in 300, 500 years from now, our descendants will think of us as being barbaric for eating animals. They will think, they ate animals. That is so barbarian-like. Now, you can think that's stupid. Why would they think that? But just think of how we think of some of our ancestors for some of the things they did in the past. We think of them us being barbaric. So things will change, times will change. It's already starting to happen now. The way we look and perceive animals is changing. It's evolving. We're becoming more empathetic around animals without a doubt. It's changing rapidly, and that's going to evolve through time. And eventually, there'll be no need for us to eat animals because there'll be alternatives there, and people will simply not eat animals, and then our mindset will change, and they'll look back at us as being barbarians. That's going to happen without a doubt. But I think this is a long-term trend. It's going to happen. We can see it happening rapidly right now, but I think it's going to happen slower and slower. So I think this is a multi-decade sort of trend. I'm not sure we can take advantage of that right now, but it's definitely going to happen. And I'm really interested to see if this comes to fruition in 500 years. And it's one of the reasons I want to get into Time Machine and see if this does actually happen. And the final part to this question, and the final question of the day, is if so, where do you see opportunities for ASX investors? Well, there's opportunities everywhere. If you keep an open mind, you can find opportunities. You can find new trends that you can get into. But it's very important here to time your entry into trends. I think that's the most important thing here, because sometimes you can be too early. You can become excited about a trend that you think is going to be very successful in the future, and time your entry into that trend a little bit too early. We saw that with lithium about 5 or 6 years ago. Some people got really hyped up about lithium. They bought in maybe a bit too early, and they went through a rise in the share price of lithium stocks, and then we saw those lithium share prices take a massive crash. And right now we're seeing the same thing happen. That doesn't mean now is the right time to get into lithium. Again, maybe it's a little bit too early. And we saw the same thing with the tech stocks in late 1999, early 2000s. We saw those tech companies go through the roof, but again, that was too early. Some of those tech companies failed, but if they just waited 5 or 10 years, they could have become successful. They were just a little bit too early to the party. So I believe it's timing our entry into trends is the most successful thing when it comes to trends. So that's all I've got for this Q&A with Kneppy Invests. If you do have any questions for my future video, make sure you leave that question in the comment section of this video, and I'll make sure I answer it eventually. So I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Hope you've enjoyed it. See you later. Bye.